this whole idea of the Fed rate cut. Now remember, it was March 2022. Rates were zero. When we say rates, let's be clear. This is the policy rate, the Fed funds target rate, also known as the policy rate, is the rate that the Fed sets as a target, and then they instruct the open market desk at the Federal Reserve Bank of New York to conduct, open market operations to target that rate. We're not talking about 2-year notes, 5-year notes, 10-year notes. Those are all different. They're very interesting, by the way, to look at the yield curve because we've had almost a year and a half at this point of a steeply inverted yield curve, which happens, but it's unusual and it's a very powerful predictor of recession. So be careful what you wish for in that sense. But so when we say rates, we're talking about this very short term, really overnight Fed funds target rate. In March 2022, it was zero, coming post pandemic, post COVID, et cetera. The Fed then began a classic rate hike or monetary tightening cycle on two fronts. One, raising rates, but they also started to reduce the balance sheet. And I still run into people that go, oh, the Fed is printing all this money. They're not printing money. They haven't been printing money for years. They've been burning money. They've been reducing the money supply. If the Fed has a 5-year note, 5-year Treasury note that they bought 5 years ago, guess what happens? The Treasury gives them their money back. They get paid. Well, if you take the money and buy a new 5-year note, you're going to keep your balance sheet the same. It's a rollover. You take the money on the old one, you buy a new one. But what if you don't do anything? You take the money and you don't do anything. That money disappears. It's the exact opposite of money printing, where the money comes out of thin air. When you are reducing your balance sheet, the money actually disappears. So number one, the Fed's been reducing the balance sheet, tightening the money supply. But number two, what your point, Shay, is they've been raising interest rates.
In this insightful finance update, Jim Rickards delves into the complex dynamics surrounding cash in the U.S. economy. As of late 2022, inflation soared to a staggering 9.1%, posing a formidable challenge for the Federal Reserve. While there has been a subsequent decrease to approximately 3.3%, it remains notably above the target range of 2–3%. Rickards underscores the Fed's delicate balancing act, navigating between reining in inflationary pressures and maintaining economic stability. This underscores the pivotal role of monetary policy in steering the nation's financial course.
So they got all the way up to, from zero, they got to 5.5%. Now, that's not the highest rate of all time. That you'd have to go back to 1982. Paul Volcker was about 20%. I think during the U.S. Civil War, 140 years ago, give or take, maybe a little more at this point, maybe 170 years ago, it was around 20%. But so it's only 5.5%, but it was the quickest 5.5% ever. It was from 0 to 5.5 in about a year and a half. That was an extremely rapid set of increases. So the question was, when would the Fed stop? And then when would they cut? And cutting rates became known as the pivot. Wall Street, it's a bit of jargon. So this is the famous pivot. Well, the Wall Street experts, I'll put that in quotation marks, started talking about the pivot in the summer of 2022. They've been wrong for 2 years. Now, nobody said, oh, they're going to cut rates in the summer of 2022. Nobody thought that, but they started to say, well, they're going to raise them a little bit more, and then they're going to pause, then they're going to cut them, and by early 2023, we'll have the pivot. And the pivot is a narrative, and the narrative goes by a couple different names. One is the soft landing. I'm sure you've heard of that. For your viewers, I'll inform them there's no such thing as a soft landing. You have a hard landing, crash, recession happens. That may be happening right now, but there is no such thing as a soft landing. So you can dismiss that one. The other one is Goldilocks. We all know the nursery story. Not too cold, not too hot, but just right. The Fed would get it just right, raise enough to cool inflation down, but not enough to cause recession. So they get it just right. So whether it was Goldilocks, the soft landing, or the pivot, these are three names for the same narrative, which is, hey, the Fed's going to cut any minute now. Start the countdown and buy stocks. Wall Street always ends the analysis with buy stocks. Everything I just said is nonsense. Everything I just said is true. That is the Wall Street narrative. That is what you see in the headlines and newspaper articles, et cetera. But none of it is true. The Fed is nowhere close to cutting rates. The pivot crowd have been wrong for almost 2 years. I mean, how long do you have to be wrong before somebody says, maybe you actually aren't thinking about this the right way? You're certainly, and what I do is, I, we all have our own opinions, but it has to be somewhat rooted in reality. If you want to be a good Fed analyst, which is one of the things I do, you have to put yourself in the shoes of the Fed. You can't just pull a narrative out of thin air. You can't make up a story. You can't tell your investors, your clients, something that makes them want to do what you want them to do. You actually have to say, I'm Jay Powell, or Jay Powell is pretty much the last word on this, and look at it from his perspective. And I dealt with Jay Powell, back in the day. Smart guy, nice guy. Interesting thing about Jay Powell, he's a lawyer. He's not an economist. He's a lawyer. So I'm an economist, but I happen to be a lawyer too. So I can, when you go to law school, you don't really learn the law. You just get brainwashed in a good, hopefully a good way. So I can think like a lawyer, as the expression goes. So you have to think a little bit like Jay Powell. Now, what is his greatest fear? His greatest fear is that inflation gets out of control, which it almost was in 2023 and 2022. You go back to late 2022 when inflation took off. And of course, the word was transitory. It was transitory. Well, it wasn't really transitory. It's still here. It peaked in June 2022 at 9.1%. It's come down a lot. It's in the low threes, so 3.1, 3.2, 3.3%. But here's what happened. It got stuck. It was so when it went from 9 to 8 to 5 to 3, everyone said, "Oh, the Fed's got this. They've got inflation under control, et cetera." But remember, their target is 2. And you say, "Well, 3, 2, it seems like they're close." Well, close isn't good enough if your target is 2. And by the way, 3% inflation cuts the value of the dollar in half in 18 years. So from birth to going off to college, your dollar's worth half. And by the time you get mid-career, you're 36 years old, half again.
Jim Rickards delves deeper into the repercussions of inflation, emphasizing that even seemingly moderate rates like 3% can have profound implications. Contrary to focusing solely on core inflation, Rickards advocates for considering headline CPI, as it reflects everyday Americans' expenditure on essentials like food and energy. Despite fluctuations, recent CPI data stands at a concerning 3.2%, higher than 6 months prior. Rickards dispels the notion of a swift rate cut, highlighting the Fed's cautious approach, which typically requires sustained positive economic indicators over several months. With recent CPI and PPI increases, the likelihood of a rate cut diminishes further.
So 3% inflation is not benign. It actually really it takes a whack at. Sorry, I said 18 years. I meant to say 22 years, but the point's the same. In a relatively short period of time, from birth to mid-career, your dollar's lost 75% of its value with 3% inflation. Sorry. So the Fed's trying to get to 2, but the problem is that inflation was 3%. Now, just to be clear, when I say inflation, I'm talking about headline CPI, Consumer Price Index, headline inflation, 3%. And immediately, the Wall Street crowd will jump up out of their seats. Oh, Jim, we have core inflation. We take out gas and we take out energy and food prices, and we're looking at core inflation. So, well, you may be looking at core inflation, but everyday Americans are not. Gas at the pump and food at the supermarket is about like 2/3 of most people's budget. It's what they spend, other than housing and home heating. It's what they spend most of their money on. So you can't just pull out the things you don't like and say, let's look at the core. Well, you can look at it, but everyday Americans are not. They're looking at gas prices and eggs and butter and milk and everything else they buy at the supermarket. So I use headline core because that's what Americans use. And if you want to understand the political aspects of this, or how people are going to vote in November, or what the Fed should really be worried about, that's the number. And then they came up with something. These are basically people who don't have enough to do. So once they got core, they took out food and energy. Oh, don't count that. Then they took out housing, and they called it super core. I'm not making this up, Shay. This is all in the literature. You can just Google super core. You'll see what I mean. So it's like, oh, okay, I get it. You took out energy, food, and housing, and to get to what you think is relevant. Okay, you're so detached from everyday Americans. You're so detached from the real, what real people are paying for, the things they need, that no wonder they get everything else wrong. Headline CPI was 3% in so we're in March, 3% in about 6 months ago. Right now it's 3.2. It's higher than it was 6 months ago. Now it fluctuated in the meantime. It got as high as 3.7. It got down to 3.1, back up to 3.2, et cetera. I'm not saying inflation is going to 20%. I'm not saying that. What I'm saying is it's not going to 2%. It's not going to the Fed's target. And it is not mission accomplished. The Fed has not solved the inflation problem, and they're still doing it. So they're nowhere near ready to cut rates. Number one. Number two, um, the Fed does not do anything quickly, only in an emergency, and I mean a complete financial meltdown of the kind I lived through in 1998 with long-term capital management. That was we almost took down the world. It came very close, um, but there the Fed had cut rates at a scheduled meeting and then cut them again 2 weeks later at an unscheduled meeting. The Fed can have an emergency meeting with they have an executive committee. They can act between scheduled dates, and they did in that case, and they lowered the rates again just to kind of put. And then the market said, okay, I guess they're serious. Now we will start to normalize. So, but that's very unusual. Normally they not only stick to their schedule, but they want to see 3 or 4 months worth of good data, not 1 month, not one good month. Oh, gee, unemployment went down, inflation went down. Let's cut rates. No, they want that because that could be an anomaly. Sometimes it is. They want to see 3 or 4 months in a row. They haven't had that. They haven't had that. It just went up in the most recent month. CPI and PPI, which were just released, not long, just in the last few days, both went up. Now, again, I'm not talking 10%. I'm not talking 5%. I'm saying wrong direction. And if you're the Fed, there's no way you want to cut rates at this point.
In today's discussion, we've gained valuable insights from Jim Rickards regarding the intricacies of the Federal Reserve's monetary policies and the implications of inflation on the economy. From the misconceptions surrounding rate cuts to the significance of headline CPI, Rickards has provided a comprehensive analysis that challenges prevailing narratives. Remember, while the Fed's primary concern remains controlling inflation, the decision to cut rates isn't imminent, especially given recent economic indicators.